Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the numbers that move the world and sometimes they try to hide them, but well, we'll dig them up. Get ready for a deep dive into NexPoint Real Estate Finance Incorporated and find out what they've been up to lately. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we break down these filings even further and chat about all things finance, so join us. Alright, let's get straight into it, folks. NexPoint Real Estate Finance, or NREF as they're known on the stock market, has dropped a report that gives us a peek into some of their recent financial dealings. Now, this isn't a full quarterly earnings report, but it is packed with crucial information about some significant agreements they've entered into. Think of it like a special bulletin, flagging some important moves the company is making. So, what is the big news on the 10th of October of last year? The company S operating arm, let S call them the OP, made a deal to sell $45 million worth of new debt. This debt is in the form of what they call senior unsecured notes, and they come with an interest rate of 7.875%. This is like borrowing money, but instead of one bank, they're reborrowing from a couple of funds, Blue Rock and the Ohio State Life Insurance Company, and to make sure these notes get paid back, the main company, NexPoint Real Estate Finance Incorporated itself, is acting as a guarantor. That means if the OP can T-pay, the main company steps in. Now, why are they borrowing this new money? Well, a big chunk of it, about $36.5 million, is going to pay off some older debt that was due to mature. This older debt had a slightly lower interest rate of 7.50%. So they essentially refinancing, paying off an old loan with a new one. The rest of the money, after paying fees and such, can be used for whatever the company needs for its day-to-day operations. This new debt is considered senior, meaning in case of financial trouble. These note holders get paid back before others. It is also unsecured, meaning there is no specific asset tied to this loan. They recounting on the company's overall financial health to repay it. Interest payments will be made twice a year, on the 15th of October and the 15th of April, starting in April of 2026. The loan is set to mature on the 10th of October 2026, but here is an interesting wrinkle. The company has the option to extend the loan for 2 additional 6-month periods. However, this comes at a cost. If they choose to extend it the second time, the interest rate will jump up by an extra 3%. This means the interest could end up being almost 11% if they use both extensions. This gives them flexibility, but also signals potential future cost increases. The company also has the right to pay back these notes early, either all at once or just a portion of them. If they do this, they'll pay back the original amount borrowed plus any interest that is built up but not yet paid. This is pretty standard for debt agreements. Now, this is a big one. If there is a change of control at the OP, meaning effectively new owners or management take over, they are obligated to offer to buy back these notes from the holders. This is a protection for the investors, ensuring they can get their money back if the company's direction changes drastically. The agreement for this loan also includes typical clauses like promises from the company that everything they've reported is true, and rules that the company must follow. These rules or covenants put limits on how much more debt the company can take on and require them to keep their finances in a certain healthy condition. This is all about ensuring the company remains stable enough to repay this new loan. Like most loan agreements, this one also outlines what happens if things go wrong. These are called events of default. This includes not paying back the loan or interest, breaking the rules we just talked about. If the company defaults on other debts or if it faces bankruptcy, if any of these serious issues occur, the note holders might be able to demand all their money back immediately. It is also important to note how this debt was sold. It wasn't offered to the general public. It was a private placement, meaning it was sold directly to what are called accredited investors. These are typically wealthy individuals or sophisticated institutions that meet certain income or net worth requirements, and they don't have the same protections as regular investors. They're relying on exemptions from standard registration requirements with the Securities and Exchange Commission. To wrap up the debt deal, the OP also made an agreement with NexBank, which seems to be their main bank. This was essentially a notification and amendment to an existing loan agreement to reflect the new debt they just issued, and to remove the old debt that they just paid off. It's a housekeeping item to keep their loan records accurate. Now, moving on to another significant transaction, on the 8th of October, just a couple of days before the debt deal, the OP also bought some stock. They purchased about 3178 shares of preferred stock in a company called NexPoint Storage Partners, or NSP. This preferred stock pays a hefty 15.0% dividend, and the price for this investment was $3.2 million. This investment isn't tea coming out of the blue. Back in June, the main NexPoint real estate finance company already owned about 25.6% of NSP's common stock. Plus, they had already guaranteed some of NSP's debts, up to about $11.4 million. So, this purchase of preferred stock seems to be an expansion of their relationship with NSP. It could be a move to get more control or to secure more influence in a company they already have a stake in. This part of the report gets a bit intricate, detailing interconnected relationships. It seems a key person at NexPoint, who also controls the company that manages NexPoint, has significant ties to both NexBank, the lender, and the parent company of the manager. On top of that, one of the new lenders, OSL, might also be considered related due to shared ownership structures. And finally, the parent company of the manager, along with its affiliates, owns almost all of the stock in NexPoint Storage Partners, NSP, the company they just invested in. This web of connections suggests that many of these deals, while presented as arm's-length transactions, involve parties who are deeply intertwined. This level of related party dealings is something to watch closely, as it can sometimes create conflicts of interest or lead to decisions that benefit insiders more than external shareholders. Now, what does this all mean for NexPoint Real Estate Finance, Inc.? First off, they've successfully refinanced some of their outstanding debt, replacing older debt with newer debt that carries a slightly higher interest rate, but extends their borrowing period. This is a common financial maneuver, but the keys here are the potential for that interest rate to climb significantly if they use the extension options, and the fact that they are increasing their leverage by taking on new debt. The purchase of preferred stock in NSP is also a notable move. It suggests they see value in NSP, perhaps as a strategic investment or a way to further consolidate their operations in the storage sector. Given that they already own a significant chunk of NSP and have guaranteed some of its obligations, this new investment might be aimed at strengthening their position and potentially improving the profitability of their combined storage assets. However, it also means they are deploying more capital into this venture. Scroll 10.1 Note Purchase Agreement dated the 10th of October 2025, by and among NexPoint Real Estate Operating Partnership, LP, NexPoint Real Estate Finance, Inc. NexPoint Real Estate Advisors VO Wine LP, and the purchases listed on the signature pages thereto 10.2 Limited Consent to Loan Agreement, dated the 10th of October by and between NexPoint Real Estate Operating Partnership LP as borrower and NexBank. As lenders scroll looking at the bigger picture, NexPoint appears to be actively managing its balance sheet and expanding its strategic interests. They're retaking on more debt with the new notes, which can amplify returns if their investments perform well, but also increases risk if they face difficulties. The investment in NSP shows confidence in that specific segment of the real estate market, and their existing relationship with NSP, along with the guarantees, suggests this is a deliberate strategy to deepen their involvement. The complex web of relationships involving directors, managers, lenders, and the companies themselves is a significant point of attention. While these arrangements can sometimes lead to efficiencies and coordinated efforts, they also carry the inherent risk of conflicts of interest. It is crucial for investors to understand who is making decisions and whose interests are being prioritized. A key risk here is the rising cost of debt. If interest rates continue to climb, or if NexPoint needs to use those extension options on the new debt, their interest expenses will go up, which will eat into their profits. Also, the heavy reliance on credit facilities and complex related party transactions means that any stumbles in their operations or governance could have magnified consequences. On the opportunity side, if their investments in storage like the NSP venture pay off, and if they can manage their debt prudently, they could see significant growth. The 15% dividend on the preferred stock they bought is quite attractive, and if NSP performs well, this could generate strong income for NexPoint. In conclusion, NexPoint Real Estate Finance, Inc. is making bold moves, expanding its debt and investing in strategic growth areas. They are navigating a complex financial landscape with significant interconnectedness between parties. While these actions signal a proactive approach to growth, investors should remain vigilant about the associated risks, particularly the cost of debt and potential conflicts of interest stemming from related party transactions. It will be important to monitor how these new debt arrangements and the NSP investment evolve in the coming periods. Alright, that is our breakdown of NexPoint's latest filings. What is your take on these numbers and what they signal for the company's future? Do you think these deals are smart strategic moves, or do the risks outweigh the rewards? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you all next time.